labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. We think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment.
All right, that was Fed Chair Jerome Powell speaking about the Fed rate cuts by quarter point yesterday. But Varun Dubey is also joining us with a roundup of all that Jerome Powell had to say, and what does it really mean? Take it away, Varun.
Definitely. So finally, it's a rate cut in the U.S. markets, and the first rate cut for calendar year 2025, and it's the first rate cut after January 2023. So 25 basis point is the rate cut that has been done, and now the range for Fed is 4% to 4.25%. And the good point is that the overall rate cut votes were actually 11:1. That means majority of the FOMC members have actually voted for a rate cut. It was only one member who was actually Stephen Miran, who actually voted for a more than 25 basis point rate cut. That was a 50 basis point rate cut. That was what he has voted for actually. So majority of the members have actually voted for a rate cut this time, and some are actually expecting more rate cuts. In fact, now the Fed is expecting 2 more rate cuts to happen in calendar year 2025. That means the going on the October and December policy can also see more rate cuts going ahead, and now the medium range, the medium projection for the year end of 2025 comes at around 3.6%, and for 2026 it comes at around 3.4%, and then after that the median range comes at around 3.1% for 2027. So you might see more rate cuts going ahead. Also, on the labor market condition, he has said that yes, the labor market conditions are softening, but they are not that bad. On inflation, the Fed is projecting the inflation is expected to be around 3% in 2025, falling to around 2.6% in 2026, and also 2.1%, then to 2.1% in 2027. So this means the overall inflation is expected to be to some extent on an elevated level going forward as well. Also, if you look why the US markets actually fell after the overall rate cut decision, one is because the US markets were already at life high and they were expecting a 25 basis point rate cut in the Fed policy, and that's the reason you have seen some profit booking. Other than that, if you look at the overall commentary of Fed chairman, it was more of a risk management rather than improving the economy, and that's other reason why the US markets actually fell after the rate cuts. So yes, the much awaited rate cut has happened, the first after January 2023 and the first in calendar year 2025, and you might see more rate cuts going ahead. So rate cut cycle for US markets have actually started now.
That's right, the rate cut cycle has started, and the key commentary that we're tracking is, of course, that it's a risk management cut. Thanks, Varun, for taking us through that entire roundup. But to discuss this further and what's going to be the impact on the U.S. economy and across the world, we're now joined by Andrew Freris, who's the CEO at Economist Advisory. Hi, Andrew. Thank you so much for joining us this morning. Well, is it like an I told you so moment? You've long been skeptic of the market's expectation for these aggressive rate cuts. Now that this more measured move has come, does this outcome validate your cautious stance, and how are you, altering your long-term outlook for the Fed policy on the back of this move that has come?
Well, there are two things here. Never mind what I think what the Fed should be doing. It is what the Fed itself does. I think this was a very bad idea to cut interest rates at this particular juncture. But as the Fed indicated very, very clearly, it was a very balanced approach, whether they are going to pay much more attention to the labor market rather than to inflation. I am paying much more attention to inflation. And I feel justified on that because the long-term bond yields, the yield curve in the States after the cut hardly moved. The long-term 10 years didn't move at all. They went down and then up and then stayed more or less flat. And the same thing with the 2 years. So the bond markets are telling us that they are not impressed. They don't think that the cut in interest rates is going to be something that's going to be reflected on the longer term side of the market, which is the one which is influenced primarily by inflation. Ta-da! So inflation is very much in the forefront of what the markets are doing. And also the overall behavior of the S&P, I wouldn't say it was extraordinary. So muted reaction, okay, because I suspect the markets, like me, are much more concerned about inflation rather than the labor market.
Right. Hi, Andrew. This is Ankita also joining in. Good morning. And in fact, that was my question to you. You know, with this rate cut coming through, the focus is clearly shifted to the labor market. What about the inflation? Is the Fed not penciling in the inflation that perhaps might ensue as a result of the tariffs? Because, you know, sooner or later, the costs will get passed on to the consumers and there will be a heated inflation. And is the Fed not taking account of that?
Well, it is taken, but they decided that the concern over the behavior of the labor market and therefore what is going to happen in the economy is more important. My question, however, is the following. Okay, so now let's pretend that we're going to cut interest rates by 125 basis points. That's the extreme use. I don't think for a moment this is going to happen. How will this affect employment? I'm trying to think, how will this affect employment? By more investment? Well, a much lower decrease in much lower interest rates is going to encourage a lot more investment on artificial intelligence. This has nothing to do with creating employment. And also it is what I will call it, a bubble approach to investment in one particular sector where the markets already have got deep suspicions as to what is going to happen with artificial intelligence. So cutting interest rates and keeping your fingers crossed that this is going to affect employment, boy, that's a very, very, very optimistic view. In general, cuts in interest rates take about 9 months to be transformed into some action in the real economy. So we're looking now 3 months plus to Christmas and then 6 months plus to midsummer. So we're looking to midsummer plus if we're going to see any impact on employment, whereas we are still assuming very significant impact on inflation. For the last 7 months, all the inflation numbers have been up, I emphasize that, or flat, not down. So the inflation trend is going up, not down. And a cut in interest rates is not going to discourage it, particularly asset inflation, which unfortunately is not reflected on the CPI.
Andrew, as you mentioned that perhaps this rate cut is not going to augur well. How will it augur well for the labor markets? That is your question. But, you know, the policymaker projections also suggest 2 more rate cuts on the annual, perhaps in the month of October and December. What do you have to say for that?
Well, I'm not sure, in fact, if that makes any sense, given also that their dot policy chart has 6 out of the 12 members saying no change. So I prefer to take this as an indicator of what's going to happen between here and the end of the first quarter, no movements in interest rates. That's what the Fed is telling me, not what I'm telling the Fed or what I think the Fed should do.
That's right. Now, Andrew, like the Fed has been mentioning that the focus is now shifting to the labor market. But like you said, if the interest rates are cut, investments might actually go into AI and may not really help the labor market. So what do you think the strategy should be to, apart from rate cuts, what else can be done? What else should be the strategy to improve the labor market?
Well, you're asking me to advise President Trump as to what does next for the labor market. Oh boy, that's quite a tall order. Of course, I have my views. The tariff policy has been an absolute disaster. Because if you're asking me right now, what is the tariff policy? I have no idea. What's happening with India and the United States? I don't know. What's happening with China and the United States? Well, the last thing we heard was that Trump was encouraging the European Union as well as himself to add more tariffs on China in order to punish it for its support by buying oil from Russia and therefore the Ukraine. It's a complete incoherent mess. That doesn't help at all for investment. Look also what has happened with the investment of South Korea in United States. They arrested about 500 Korean workers and they threw them out. And in fact, when the Korean workers were asked if they want to stay in the States, they all said no. I mean, hardly a big move, but all showing that the Trump administration hasn't a clue as to what to do next, except carry on putting more tariffs, and then they proceed not to. At least if they said, okay, we're going to impose 50% on India, well, do it tomorrow. Ring up Modi and says, for Monday, we are increasing all our tariffs by 50%. It's not happening. I'm not saying it's a good idea. All I'm saying is that if one is asking what can the Trump administration do in order to increase employment, their idea was to use tariffs. Well, they are not even doing that.
All right, Andrew, thank you so much for taking the time out and joining us and weighing in on the FOMC decision. Thank you for joining us then. And now we'll move on to the top headline.